Here is what separates the people who come out of a market crash wealthier than when they went in from the people who lose everything and never recover. And I promise you, it has almost nothing to do with timing the market or predicting what happens next. It has everything to do with what you do before the storm arrives. Let me paint you a picture. Two people, same neighborhood, same income bracket, both in their mid-30s, both watching their portfolios in early 2020, thinking things would probably be fine. They were not fine. The market dropped over 30% in a matter of weeks. One of those people came out ahead. The other locked in massive losses and is still recovering years later. The difference was not luck. The difference was preparation. Everything that mattered happened in the months before the crash, not during it. So today we are going to walk through exactly what smart people do before a market crash, because most people never do any of this, and that is why most people get destroyed. Before we get into the actual playbook, let us talk about where markets stand right now, because ignoring this would be doing you a disservice. The Shiller-Cape ratio, which measures how expensive stocks are relative to their long-term earnings, is sitting in the high 30s. The historical average is around 17. We are more than double the long-term normal. The last time we saw readings like this was during the dot-com bubble, right before the Nasdaq lost close to 80% of its value. On top of that, the concentration inside the S&P 500 is at levels we have not seen in decades. 7 companies currently account for somewhere between a quarter and 30% of the entire index. When you buy a standard S&P 500 index fund thinking you are diversified across 500 companies, you are not. You are heavily concentrated in a handful of the most expensive stocks on Earth. And when those companies correct, they can drag the entire index down hard while giving you almost no protection from what you thought was diversification. Add geopolitical instability, sticky inflation, elevated recession probabilities from major financial institutions, and a weakening consumer confidence picture, and the conditions that have preceded every major market correction in modern history are clearly present right now. None of that means a crash is certain or imminent. What it means is that being financially unprepared right now is an enormous mistake. So here is the actual playbook. 5 things. None of them require predicting when the crash happens. Number 1 is the emergency fund. And I need you to stop thinking of this as a boring beginner tip, because it is not. Your emergency fund is the single piece of financial infrastructure that determines whether a market crash is a catastrophe for you or just a number on a screen. Here is the brutal reality. If the market drops 40% and you have 6 months of living expenses sitting in cash, that decline means almost nothing to you. You keep contributing. You wait. You actually come out ahead buying more shares at lower prices. If you have almost nothing in savings, that same market drop becomes a timer. The moment any unexpected expense hits, and they always do, you are forced to sell investments at the worst possible moment and lock in permanent losses. That is not bad luck. That is math. You need 6 months of actual expenses in a high-yield savings account, not a standard bank account earning essentially nothing. Right now, you can find high-yield accounts paying between 4 and 5% annually. Your money should be working while it waits. Number 2 is high-interest debt, and this one has a clean mathematical answer. Any debt you are carrying above a 6% interest rate needs to be eliminated before you make additional investments beyond your employer match. Here is why. The S&P 500 has returned roughly 10% annually over the long run on average. If your credit card is charging 20 or 22%, Paying that off is a guaranteed 22% return on every dollar you apply to it. No investment on Earth offers you a guaranteed 22% return with zero risk. Americans are collectively carrying over $1 trillion in credit card debt right now at record high balances. That debt load, combined with limited savings, is exactly why crashes hit ordinary people so much harder than they need to. One critical exception here: always contribute enough to your workplace retirement account to capture the full employer match before attacking debt. That match is an instant 50 to 100% return before the money even touches the market. Capture that first, then eliminate the high-interest debt from highest rate to lowest. Number 3 is portfolio rebalancing. And this is where most people have no idea what they actually own. When is the last time you looked at your actual allocation, not just your balance? If you own a standard market cap-weighted S&P 500 index fund, you are significantly concentrated in the largest technology companies, whether you realize it or not. In 2022, those mega-cap tech names fell over 40%, while the broader index fell around 19%. Concentration unwinds fast, and it is not gentle. A rough starting framework: subtract your age from 110. That gives you a ballpark equity percentage. If you are 35, think around 75% equities. If you are 50, closer to 60%. And if your equity exposure is heavily weighted toward large-cap U.S. growth stocks, consider equal-weight index funds, which give every company in the index the same position, rather than letting the largest companies dominate your returns and your losses. Sectors like consumer staples, utilities, and healthcare have historically held up significantly better during major downturns. You are not trying to predict anything. You are just making sure not everything is in the most fragile basket. Number 4 is continuing to invest through the decline. This one is going to feel wrong when you are actually in it. When your account is down 25%, and every headline uses the word collapse, every instinct will tell you to stop contributing and wait for stability. Do not do this. When markets fall, you are buying shares at a discount. The research on missing just the 10 best trading days over a 20-year period is staggering. The difference between staying fully invested and missing those 10 days cuts your ending wealth roughly in half. And approximately 78% of the market's best days occur either during a downturn or in the very first moments of recovery. If you are sitting in cash waiting for things to feel safe, you miss those days entirely and you never get them back. Number 5 is using Roth accounts strategically. And almost nobody talks about this when markets drop. When asset values are lower, contributing to or converting into a Roth IRA becomes dramatically more powerful. With a Roth, you pay tax now on a smaller number, and everything that grows from that point forward, the entire recovery and decades of compounding, comes out completely tax-free. If you have a traditional IRA that dropped in value during a crash and you convert it to a Roth, you are paying income tax on the reduced value, not the original value. You are essentially getting a discount on your future tax bill because you acted when prices were down. The 2026 Roth IRA contribution limits are $7,500 if you are under 50 and $8,500 if you are 50 or older. Income limits apply, and above those limits, a backdoor Roth conversion is still fully legal and available at any income level. Now here is the part that is harder than any of the financial mechanics: the psychological part. Nobel Prize-winning research shows that losses feel roughly twice as painful as equivalent gains feel good. This is not a personality flaw. It is hardwired into how human brains work. And it is why otherwise rational people make catastrophically bad financial decisions at exactly the wrong moment. Historical sentiment data shows that investor pessimism hits its highest point right at market bottoms, and bullish confidence peaks right before major collapses. The people most certain things will keep going up are usually standing at the edge of the cliff. Nearly a third of investors who sell during a downturn never return to the market. They lock in the loss permanently and walk away from the recovery entirely. The solution is to make your decisions now, before you are inside a frightening moment. Write down your plan. Decide today that you will not sell your long-term investments during a crash, because your emotional state when your account is down $50,000 at midnight is genuinely the worst financial advisor you could possibly consult. The people who build wealth through market crashes are not the people who predicted them. Nobody consistently does that. They are the people who built their cash cushion, eliminated their high-interest debt, rebalanced their portfolio, kept contributing through the decline, and used the tax advantages a down market creates. Not one of those things requires knowing when the crash happens. They just require doing the work before it does.